Audio Jungle. Audio Jungle.
Visit any financial advisor in India, and almost every one of them is going to suggest to you that bhaiya stocks mein laga do. And this leaves you all ends up because you have all sorts of complex investing terminology like mutual funds, buy and hold, value investing, growth investing, dividend investing, etc. coming to your mind. And you're just looking for that starting point, right? Investing in stocks is one of the best, if not the best way of achieving your financial freedom and retiring early. From getting those quick dividends in your bank account to holding onto these stocks so that you can cash in late and hit big, stock market investing offers everything. The biggest question facing most of the people out there is, how can we make money through stocks? Today's your lucky day because in this video, we're going to bring forward those 7 important steps you need to follow to get your investing journey off and running in the Indian stock market. So without any further delay, let's dive right into the thick of things. Number 1, the ultimate buy and hold strategy. While some people might put you off by saying it's too risky for ordinary people like us, let us just tell you that time in the market beats timing the market. To put a long story short, one of the most exciting and profitable ways of making money in the stock market is through using the buy and hold strategy of investing in stocks. Now, this is a strategy that allows you to buy a certain stock or security or invest in a mutual fund and hold on to it for some time instead of just going through the traditional route of following the blitzkrieg, buying stocks and selling rapidly. For example, if you invest in any one of the leading indices like the BSE Sensex or the Nifty 100, there's every chance that these indices will bring some profits for you. And let's be honest, you may experience some losses as well. The point is, you're going to hold on to your investment for the long term instead of making your decisions based on some short-term profits or losses. Let's just look at another example to grasp the key concepts over here. If you are in that business section of some popular newspapers in Bombay or Delhi, you'll probably know that the stock market brought returns worth 9.9% annually for everyone who remained invested during the 15 years through 2017. Now, if you went in and out of the market during that time, you would have lost the chances of making some serious profits. Number 2, funds and individual stocks. Seasoned investors know that a time-tested investing practice called diversification is key to reducing risk and potentially boosting returns over time. Think of it as the investing equivalent of not putting all of your eggs in one basket. Although most investors gravitate towards two investment types, individual stocks or stock funds, such as mutual funds or exchange-traded funds ETFs, experts typically recommend the latter to maximize your diversification. While some advisors might suggest you invest in individual stocks for diversification, you should know that investing in mutual funds is an automatic way of getting some diversification in your portfolio. An individual share can cost you thousands of dollars. And on the other hand, you can get some exposure to hundreds or even thousands of stocks by buying a share of any fund. That's why experts recommend most people invest in funds that passively track major indexes, like the NSE Nifty or BSE Sensex. This positions you to benefit from the approximate 10% average annual returns of the stock market as easily and cheaply as possible. Number 3, reinvesting your profits. When you invest in a company, you're buying into that company. You are a shareholder, and that means when the company you invested in makes some profit, you're gonna get some piece of cake. This piece of cake is known as a dividend, which most companies are fond of giving out so that their shareholders keep up with them. While the amounts may seem small, they can make a bigger impact once you understand the concept of reinvesting. For example, Nifty 50 at the time of its inception was giving out around 12% of returns. But INC the dividends were reinvested. The magic started happening and the returns jumped up to 16%. That is a big hike, keeping the macroeconomic conditions in regard. Now that is because each dividend you reinvest is just going to go out and buy some more shares for you. You can assume every rupee as your servant, who goes out there and convinces other rupees to start working to bring in even more rupees for you. This enhanced compounding effect is why many financial tycoons like Warren Buffett suggest long-term investors to reinvest their profits to make even bigger profits. Number 4, dodge those taxes. Now, the investments you select for yourself are of utmost importance in your journey to financial freedom. But remember that the account you choose to put the profits in is also very important. That's because some investment accounts give you the benefits of certain tax advantages, like the National Pension Scheme in India. It lets you avoid paying taxes on any gains or income you receive while the money is held in the account. This can turbocharge your retirement funds as you can defer taxes on these positive returns for decades. The minimum amount required to open an NPS account is 500 Indian rupees, and each subscriber can have a maximum of one account. NPS Tier 1 is a tax-free investment exempted from tax at all stages of investment and return. The invested amount, profit earned on it, and the total amount withdrawn at the end of the scheme are all tax-free. One can take out up to 60% of their total investment after the age of 60. This 60% investment will be considered tax-free. Number 5. Research the companies you're going for. One of the most important steps in your journey to stock market success is the research. You can't just invest in companies you don't know anything about. Now, not to say that you need to be some sort of a math whiz or a magician with a stick. The more you know about these companies you're going for, the better it becomes for you in the long term. Now, many money moves you're going to be making in the stock market actually requires a lot of homework to be done. As Warren Buffett once said, never invest in a company that you don't understand. For example, if you've decided to invest in a software company in India, which specializes in data security and analytics, make sure you know how it goes around and how the company will work in general. This is where your accounting skills will come to your rescue. The more you know about the number game, the better insights you can have about a company after looking at its annual progress reports, balance sheets, and much more. Number 6. Buy low, sell high. If you've decided to put your savings in the share market, then one thing is for sure, you're going to see some downturns in your journey. But do you know what's the best part about this game? These downturns come with an opportunity to make a significant fortune. When the market is undergoing a recession, like the recession during the COVID pandemic or the dot-com bubble in the US, it is obvious that the market will plunge down. But once the market goes down, it is bound to come up at some stage. So, what if you decide to play safe when others are being greedy? And be greedy when others are play-in, it's safe out there. To put it in stock market language, when the market is undergoing a recession, the stock prices go down and people are selling their share at relatively low rates. This is a great time to actually buy those stocks. However, the saddest part about this is that it is not the popular opinion and people often back out. The rule is pretty simple, folks. Buy low and sell high. Number 7. Don't watch the market too closely. The market lies. Simple as that. Whenever you'll see some fluctuations in the market, remember what Mr. Buffett has to say. Don't watch the market closely. If you buy good companies, you're going to do fine 10, 20 or even 30 years from now. But patience is the name of the game. Trying to react to what the market has to offer is going to backfire in most cases. And similarly, according to the legendary investor Jack Bogle, don't let these changes in the market, even the big ones, like the financial crisis, change your mind. And never, ever be in or out of the market. Always be in at a certain level. So that was all from today, folks. So what do you guys think about these 7 important steps to investing in the stock market? Do you want us to make a separate video on the buy and hold strategy? Let us know in the comment section below. Make sure you press the like and subscribe button, and we'll see you guys in the next video.